So this is ACC Amit, and let's discuss about the insights on IFRS. Insights of IFRS. We'll discuss about how it came into being, who were the people behind it, and what is the reason for developing international financial reporting standards. The biggest reason was the confusion in accounting globally. The globalization led to MNCs doing business around the world, but the regulatory authorities still demanding filing of financial statements in their own gap, which expected accountants to be very diligent in approach, and they should be capable of knowing all the gap which was prevalent in the world, generally accepted accounting principles. Like languages, accounting also had different languages or different ways of presentation, and every time we had to prepare consolidated financial statements, it was a big task. The group of 9 countries in 1973 decided to develop uniform accounting standards, and they formed a committee known as International Accounting Standards Committee. They had no idea that this development of international accounting standards will be so big in future that all the countries around the world will someday implement it. They had no idea about it. It was just France, Germany, Netherlands, UK, Japan, Australia, US, Canada, Mexico, thinking of developing uniform accounting standards. So they decided that they will be implementing it in their own country, and then we will also offer it to the world for implementation. So this committee started issuing standards, and the first name they coined was IAS, International Accounting Standard. IAS 1 was the first standard presentation of financial statements. They developed IAS 2 inventories for recording inventory valuation. They also developed IAS 3, IAS 4, IAS 5, IAS 6, IAS 9, IAS 11, IAS 13, IAS 14, IAS 15. The numbers I've just mentioned are no more relevant and applicable today. They're either merged with other accounting standards or they are either withdrawn. The standards which are still relevant and applicable are IAS 1 presentation of financial statements, IAS 2 inventories, IAS 7 statement of cash flows, IAS 8 accounting policies, changes in accounting estimates and errors, IAS 10 events after the reporting period, IAS 11 construction contracts, which was recently removed and was removed with IFRS 15 revenue from contracts with customers. So till 2018, IAS 11 was relevant, but that's how it disappears from the list because either a new standard has been introduced against it, or either it merges with another accounting standard, or it is not relevant. So after IAS 10, the relevant standard today is IAS 12 income taxes, IAS 16 property, plant and equipment. IAS 17 leases recently was withdrawn. IAS 18 revenue was withdrawn in 2018-19. These were the latest standards which were withdrawn from the list. So after IAS 16, the next relevant standard you will find today is IAS 19 employee benefits, IAS 20 government grants, IAS 21 the effects of changes in foreign exchange rates. IAS 22 is missing. IAS 23 is borrowing cost. IAS 24 for related parties. IAS 26 for retirement obligations. IAS 27 for separate financial statements. IAS 27 used to be separate and consolidated financial statements. But consolidated financial statements are being shared through standards like IFRS 10, IFRS 11, and IFRS 12. So IAS 27 is just left with separate financial statements. IAS 28 was the standard for investment in associates. With the withdrawal of IAS 31 interest in joint ventures, joint venture accounting is now merged with IAS 28. So IAS 28 became IAS 28 investment in associates and joint ventures. IAS 29 is for hyperinflationary economies. IAS 30, 31 are no more relevant today. IAS 32 is for financial instruments presentation. Any curriculum or any accountancy body who test IFRS in the examination, they don't test these standards. IAS 26 retirement obligations, IAS 29 hyperinflationary economies, or IFRS 4 insurance contracts. Reason being, they are not generally applicable for everyone. Only someone specifically working in these industries need these accounting standards. Everyone doesn't need them. So they are not generally tested. IAS 33 was earnings per share. EPS is the standard, the only performance measure which has got the stamp of authority of being a accounting standard. That the measurement of performance is presented through an accounting standard. That means it is of relevance for the users of financial statements. IAS 34 interim reporting. If anyone is presenting financial statements for the interim period, they need to follow IAS 34. IAS 36 is for impairment of assets. We learnt about standards relating to assets like IAS 16 property, plant and equipment. We'll also see IAS 38 intangible assets. Now, how to deal with impairment of assets? What if the carrying amount is higher than its recoverable amount? Is there any way we can test for impairment? IAS 36 guides us on the impairment of assets. IAS 37 is for provisions, contingent liabilities, and contingent assets. It helps us in understanding when can we create a provision, when it is mandatorily required to be presented as part of the liabilities. When there is a present obligation, there is a probable outflow of economic resources and it can be liably estimated. We need to create a provision, we cannot ignore it. IAS 38 is for intangible assets. IAS 39 was the standard for financial instruments recognition and measurement, which was recently withdrawn in 2018. A new accounting standard IFRS 9 has been introduced. You'll not see IAS 39 also in the list. IAS 40 is the standard for investment properties. IAS 41 is the standard for dealing with biological assets, living animals and plants, the standard on agriculture, the most interesting one. That one mango tree can have 3 accounting standards applicable onto it. The mango tree itself could be part of IAS 16 property, plant and equipment. Mango fruits on the tree could be part of IAS 41 agriculture. And the plucked fruits forms part of IAS 2 inventories, one of the most interesting standards. And this was the time when International Accounting Standards Committee reached a point wherein they had spent 27 years developing these accounting standards, but they did not become successful in getting it implemented. If you see in this list, there are many standards which are missing, withdrawn, and the relevant standards today are IAS 1, IAS 2, IAS 7, IAS 8, IAS 10, IAS 12, 16, 19, 20, 21, 23, 24, 26, 27, 28, 29, 32, 33, 34, 36, 37, 38, 40, and 41 are the relevant and applicable standards among IAS, International Accounting Standards. Now, the biggest confusion is I did use the word IFRS in the middle. What is it? I'm saying IAS is relevant, then what is IFRS? Do we need to use IFRS? So by the time they reached year 2000, there was one accounting standard which was creating a lot of trouble for them. It was IAS 8 accounting policies, changes in accounting estimates and errors. IAS 8 accounting policies had this requirement that if you change an accounting policy, you need to apply the effect retrospectively. Applying the effect retrospectively means as if we have been doing it since beginning. Now the expectation was that if anyone is using international accounting standards for first time, they need to behave as if they have been using international accounting standards since beginning of their corporation or since the beginning of time. This was not possible or not easy for everyone to implement it. No one would like to get into this because it will take a lot of time, a lot of money. to get it implemented, and they're not even aware of the benefits of it. And International Accounting Standards Committee was turning out to be a failure. They have spent 27 years of their life, and still they have not reached a situation where they could convince any of the accountancy bodies in the world to get it implemented. IAS 41 was the last standard which was issued in year 2000. In 2001, it was dawn of a new era. They decided to form another body known as International Accounting Standards Board. And they thought the committee will become foundation. International Accounting Standards Committee will become International Accounting Standards Committee Foundation. And today it is known as IFRS Foundation. IFRS Foundation is monitoring International Accounting Standards Board. And the first task at the hand of the International Accounting Standards Board was to get it implemented, promote it, bring harmony in accounting standards globally, improve and develop international accounting standards. Like a new CEO in the business, ISB also coined a new term, International Financial Reporting Standards, IFRS. Someone asked, what about the work done till date? They were smart enough to carry forward the work which they did. Accounting is all about carrying forward your assets. Whatever assets they have created in the form of intangible assets, and they earn revenue out of it using the copyright of IFRS IAS. These are copyrighted material today. Anyone willing to study them or use them need to pay to ISB. They were smart enough to carry forward all the intellectual material or intangible asset created over time. It is still relevant and applicable. And they were ready to even delete what was not needed. And the best thing is they don't even give a paragraph the same number which is deleted. They don't give any accounting standard the same number which is withdrawn. They will merge the accounting standards or they'll withdraw them. Like revenue was IS 18 revenue, IS 11 construction contracts. Now these spots will remain vacant, but this will not be given to any other accounting standard. The new accounting standard is IFRS 15 revenue from contracts with customers. And this problem being created by IAS 8 accounting policies changing accounting estimates and errors, which said that if you change an accounting policy, you need to apply the effect retrospectively, was countered by introduction of IFRS 1 first time adoption of IFRS. The first standard issued by International Accounting Standards Board was IFRS 1 first time adoption of IFRS, which gave boost to the development of IFRS and also implementation of IFRS. Then later they introduced IFRS 2 share-based payments, IFRS 3 business combinations, IFRS 4 insurance contracts, IFRS 5 non-current assets held for sale, IFRS 6 exploration for and evaluation of mineral resources, IFRS 7 financial instruments disclosures. Withdrawing IAS 14 operating segments, they introduced IFRS 8 operating segments. Withdrawing IAS 27 consolidated financial statements and leaving IAS 27 alone, they introduced IFRS 10 consolidated financial statements. Withdrawing IAS 31 interest in joint ventures, they introduced IFRS 11 joint arrangements. And also one more standard for disclosure of consolidated financial statements, IFRS 12 disclosures. There were three accounting standards for financial instruments, IAS 32 for presentation, IAS 39 for recognition and measurement, and IFRS 9 for financial instruments. They've withdrawn IAS 39 recognition and measurement and have improved hedge accounting, introduction of ECL model in IFRS 9, and have withdrawn IAS 39. There are still three standards on financial instruments, that is IAS 32 for presentation, IFRS 7 for disclosures, and IFRS 9 is the main standard for dealing with financial instruments, for recognition of financial assets and financial liabilities, and also dealing with impairment of financial assets and accounting for hedge accounting, though hedge accounting is voluntary. So So IAS and IFRS, the only difference is the accounting standards which were issued before year 2000. They are known as IAS. The accounting standards issued after year 2000, known as IFRS. There is no difference. The only difference is of the date of issue. The question is, what shall I learn? Shall I learn IAS or shall I learn IFRS? We need to understand all the relevant accounting standards which are applicable today, and both IAS and IFRS are applicable with equal prominence. And when I say I'm using IFRS, which also means I'm using IAS standards as well. Because there is no standard in the list of IFRS for property, plant and equipment. So I have no choice other than using IAS 16 property, plant and equipment. If I need to learn about government grants, I need to refer IAS 20 government grants. If I need to decide my accounting policies, I have no choice other than following IAS 8 accounting policies, changes in accounting estimates and errors. IAS 1 for presentation of financial statements. It's of equal importance. Now, as they progressed, there were confusions also in terms of interpreting accounting. Like the builders or contractors were always confused which standard is for them, IAS 11 construction contracts or IAS 18 revenue. The normal tendency was they will use IAS 11 construction contracts because it had percentage of completion. They were happy using IAS 11 because it was allowing them to recognize revenue early. If they had opted for IAS 18 revenue, it would result into sales of goods, and they'll end up recognizing revenue after 3 years or 4 years on completion of their project when they hand over the sale of goods to the customer. So that sale of good was a flat or a building, but revenue was recognized only when it was handed over to the customer. So they were happy following IAS 11 construction contracts. ISV had to set up another body known as Standards Interpretation Committee. The job of Standards Interpretation Committee is to interpret the standards to give clarity for use of accounting standard. Before year 2000, this was known as Standards Interpretation Committee (SIC), and any interpretation issued was in the name of SIC 1, SIC 2, SIC 3, SIC 4. The interpretations issued after year 2000 were known as International Financial Reporting Interpretation Committee (IFRIC), known as IFRIC. Like for deciding whether IAS 11 construction contracts is applicable or IAS 18 revenue is applicable, IFRIC 15 agreements for construction in real estate solved the problem. They said that if buyer has control over design and specification, it will be IAS 11 construction contracts, and if buyer has no control over design and specification, they need to buy the flat as specified by the builder, and it gets handed over only on completion of the project. It's a sale of goods. They cannot recognize revenue early. This clarity was guided by IFRIC 15 agreements for construction real estate. Then there was requirement for dealing with customer loyalty programs. They came up with IFRIC 13 customer loyalty programs, IFRIC 12 for service concession arrangements. SIC 31 barter transactions were still relevant till the introduction of IFRS 15 revenue from contracts with customers. But thankfully, all these interpretations and standards are merged today, and there is only one accounting standard for revenue, that is IFRS 15 revenue from contracts with customers. The list after IFRS 12 was IFRS 13 for fair value measurement. The definition of fair value is clearer and easier today. It's the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants on the measurement date, which was a price that could be exchanged between knowledgeable willing parties in an arm's length transaction. Now, the definition of arm's length was creating a lot of confusion. At what point, where, exit price or entry price, advantages or principal market, There was no clarity on picking the fair value. Thankfully, we have a standard specially for fair value. IFRS 13 fair value measurement. IFRS 14 for regulatory deferral accounts. IFRS 15 for revenue from contracts with customers. IFRS 16 for leases. And the latest standard on the block is IFRS 17 insurance contracts. This is the last standard issued by IASB till date. That's the journey so far. In 2023, it's been 40 years. The time spent in developing, implementing, and making them truly global. When IASB was formed and they issued IFRS 1, European Commission got convinced and they made it mandatory for all the multinational entities in Europe to prepare consolidated financial statements based on IFRS. This was a turning point for the development of IFRS. In 2007, Securities Exchange Commission allowed filing of non-US entities in IFRS instead of US GAAP, which was a big breakthrough for non-US entities. A lot of entities, even before implementation of IFRS in their own jurisdiction or own country, since they were multinational in nature, since they were listed on the stock exchange in US, started preparing financial statements based on IFRS for the purpose of filing in US. They were the torch bearers. They were ahead of time. In 2007, Australia, New Zealand, South Africa decided to move to IFRS. In 2008, in G20 summit, India, Canada, Brazil, Argentina were supposed to move to IFRS from April 2011 or January 2011 as per the financial year in their country. In India, we were supposed to move to IFRS in 2011. Luckily, I was studying the subject on IFRS in 2008 and I appeared for my IFRS exam in 2008. And I had no idea that the accounting paper I was studying will become a big phenomena in my life or will be a turning point in my life. In 2009, I also got a job to train people on IFRS on the subject of IFRS, which was expected to be implemented from 2011. It was postponed and my career also ended with the time spent on training. It was actually implemented in India in 2015. 1st April 2015 was the date of transition in India. It was mandatorily applicable from financial year beginning 1st April 2016. If it is beginning from financial year of 2016, that is 1st April 2016, that means the first IFRS compliant balance sheet known as Ind AS in India was published of 31st March 2017. The comparative of 31st March 2016 was also based on IFRS, that is converged form of IFRS known as Ind AS in India. And to be able to do so, they had to publish one more balance sheet of the beginning of the earliest period presented. So whenever there is a change in accounting policy or correction of a prior period error or implementing IFRS for first time, an entity or that country will need to publish 3 balance sheets for the first time. And the third balance sheet was of the date of 1st April 2015. The balance sheet of 31st March 15, which was based on previous accounting, was converted applying IFRS 1 first time adoption of IFRS or Ind AS, and we had first converted balance sheet of 1st April 2015. This is the date of transition balance sheet. But the first IFRS compliant balance sheet in India was of 31st March 2017. In India, IFRS is known as Ind AS. It got implemented in phases in India from 2015, 16, 17, 18. Banks, insurance companies were supposed to move to IFRS from 1st April 2018. All the NBFCs, housing finance companies have moved to IFRS. Banks have postponed it for an indefinite period. Insurance companies were waiting for the standard on insurance contracts to get applicable globally, which is implemented now or in process. It's round the corner now. So Ind AS 117 insurance contracts will be applicable in India now. The interesting question is like, why am I saying IFRS 17 as Ind AS 117? Why am saying IFRS is similar to Ind AS? So the big difference is that International Accounting Standards Board allowed conversions to IFRS. They gave a choice that you can either adopt IFRS, like US was the first entity to declare that they will adopt IFRS in 2014. But thereafter they are silent. The new standards being developed by them are more or less similar to IFRS, like ASC 606. Revenue from contracts with customers is same as IFRS 15, almost similar. ASC 842 leases is same as IFRS 16 leases. The standard on financial instruments is similar. The standard on business combinations is almost similar. The accounting is almost similar now with US GAAP, but there are changes, like they do not use the concept of revaluation model under property, plant and equipment. IFRS uses a concept known as revaluation model, which is missing in US GAAP. There are differences, but accounting thankfully is more or less similar globally today. One can consider themselves as global professional accountant. So this difference of adoption and convergence is really interesting, that all the accountancy bodies and countries are using IFRS, but they are converging it in their home country. Like in India, we coined the term Ind AS for IFRS. And if we are using IS 1 presentation of financial statements, we'll use it in the name of Ind AS 1 presentation of financial statements. If we are using IS 2 inventories, we'll use Ind AS 2 inventories. If IS 3 is missing, thankfully Ind AS 3 is also missing. If IS 4 is missing, there is no Ind AS 4, no Ind AS 5, no Ind AS 6. The next standard is IS 7, so we have Ind AS 7, Ind AS 8, Ind AS 9, Ind AS 11, Ind AS 18, Ind AS 15, 14, 13 are also missing, because there is no corresponding IFRS standard against them. Now we reached IS 40 investment property. We converted it to Ind AS 40 investment property. IS 41 was agriculture, which turned out to be Ind AS 41 agriculture. After IS 41, the next standard is IFRS 1, first time adoption of IFRS. What to do now? What number shall I give it in the form of Ind AS? So I think after our understanding or queries or questions or brainstorming, it must have been decided that IFRS 1 will use Ind AS 101, first time adoption of IFRS. IFRS 2 share-based payments will be Ind AS 102 share-based payments. IFRS 3 business combinations will be Ind AS 103 business combinations. IFRS 4 insurance contracts will become Ind AS 104. The series moved up till IFRS 17. So IFRS 15 is Ind AS 115. IFRS 16 is Ind AS 116. IFRS 17 will be Ind AS 117 insurance contracts in India. Before it gets declared in India, if you wish to learn IFRS and wish to learn about insurance accounting, you can refer directly IFRS 17 insurance contracts and your life will be easy. This is known as convergence of IFRS. It's not about India. Singapore did the same, SFRS 1, SFRS 2. Australia, New Zealand, ANZ FRS 2. Bhutan, BFRS. Sri Lanka, SLFRS. Nepal, NFRS. Saudi, it is SOCPA. Almost converged to IFRS. It's UK IFRS now being developed. UK was in a fix today because that European Union level, they were using EU IFRS, and since they were out of Brexit, the small and medium enterprises were using IFRS, but there was no standard guideline for their private companies, which were large. They are in the process to change now. Almost all the jurisdictions in the world are now using IFRS, has either converged or are in the process of convergence or have either adopted. Mainly the countries who did not have their own accountancy body adopted IFRS. This is the reason they are truly global in nature, truly international in nature. And if I talk about the accountancy bodies using IFRS, all the accountancy bodies, whether you study from India in your CA final financial reporting, you will study Ind AS, which is similar to IFRS. In CPA Australia, you study the same financial reporting paper based on IFRS. In ACCA, you study three papers based on IFRS. One is financial accounting, financial reporting, and strategic business reporting. In ICAW, in CIMA, in any accountancy body in the world, the US GAAP uses are there for CPA US. They are not using IFRS as of today, but at the university level, they are understanding or discussing international accounting because this is impacting the world anyway. US directly or indirectly is using IFRS in the form of revenue, leases, financial instruments, insurance contracts. They've already moved to IFRS using similar standard based on insurance contracts. It's just on the outside that they are not using IFRS, but they have started moving to IFRS slowly and steadily. And the moment they declare about IFRS, there will be another tide of requirement of the people who has knowledge of IFRS. So the opportunity has not gone yet. The opportunity is still there. In India, all the entities which are having a net worth of more than 250 crores are required to present financial statements based on IFRS. That is Ind AS. If someone is willing to benefit out of the opportunity in India, it is soon going to be declared for entities worth more than 50 crore. Thousands of companies will have to implement Ind AS, like it is being done for small and medium enterprises. The irony is that we have IPO for SMEs, but the IPO for SMEs is still using the previous accounting standards. The day is not too far when we'll have to implement Ind AS for small and medium enterprises. There's no choice left now. If we wish private players to invest in these small and medium enterprises IPOs, IFRS or Ind AS will add fuel to the fire. And without it, it will not be as successful as it is today. So the requirements will not be as detailed as it is required for full financial statements of IFRS, but still they will be considered worthy, detailed, fairer in approach. Though they are fairer in approach even today, but they are generally accepted globally today. So they'll add more value to the financial statements and will be able to attract more money. With the introduction of IFRS in India, we have attracted good amount of foreign direct investment in India. It has triggered the growth, propelled the growth of investment in India. It is one of the factors for receiving money from all the corners of the world, because implementation of IFRS has really helped in believing in our financial statements, boosting growth, mobility of the capital in India, and also making our resources globally capable of serving the world. The outsourcing industry in India is booming or is growing at a very fast pace. We're growing like anything. If I talk about the summary of all the standards, the first standard is IS 1 presentation of financial statements. IS 1 simply shares us the requirements that we need to publish statement of financial position, statement of P&L and other comprehensive income, statement of cash flows, statement of changes in equity, and something which we could not present in these will present in notes to accounts. It gives us a choice that we can present our financial statement in liquidity order approach or current non-current distinction or a mixed order approach for presenting our balance sheet. So mainly financial institutions opt for liquidity order approach. Non-current current distinction simply means that if something is current, it gets realized within 12 months from the reporting date, gets settled within 12 months from the reporting date. The only exception is the operating cycle. Operating cycle can be more than 12 months. So inventories will form part of our current assets, which we intend to sell within 12 months from the reporting date. Anything other than current is considered non-current. Statement of P&L and other comprehensive income. P&L is about the realized gains and losses. OCI is about unrealized gains and losses. In a layman's language, I normally say that OCI is something which is out of control of management and P&L is something in control of management. OCI has items like revaluation surplus, that we are revaluing a property, plant and equipment. A revaluation of property, plant and equipment has nothing to do with the management. It's the passage of time which has resulted in increase in value of an asset, which we recorded as a gain in the books. We increased the value of an asset and have shown this gain as part of OCI. We did not give any credit to the management. We did not blame them either, because the tax authorities visited our place because they got to know that our asset, which was worth 5,000 yesterday, is worth 500 crore today. Sensing money, they visited our place, but they didn't get anything because we simply changed the value in our books, but there was no money actually. So when you are selling an asset, it will result in some disposal of an asset, which will in turn result in profit or loss on disposal, which is a decision taken by the management, which is recorded as part of P&L. But revaluation of an asset does not result in any realized gain, so unrealized gain is shown as part of OCI. In a similar fashion, unrecognized actual gain and losses is not in control of the management, so we show it as part of OCI. Foreign currency translation reserve is shown as part of OCI. The effective portion of a cash flow hedge, the ineffective portion, we can blame the management, so we show it as part of the P&L. Other than them, if there is any fair value through OCI debt instrument, any movement relating to remeasurement based on fair value through OCI is shown in OCI. If it is a equity instrument designated at fair value through OCI, any movement during the year will be presented as part of OCI. Among them, fair value through OCI, equity, revaluation surplus, and unrecognized actual gain and loss is never reclassified to P&L even on settlement. The foreign currency translation reserve or fair value through OCI debt instrument or effective portion of cash flow hedge may or may not be classified to P&L on settlement. Statement of cash flows is globally similar. We have two methods, direct method, indirect method, for presenting the movement of cash flows in terms of operating, investing, and financing activities. We share the cash movements at the opening, movements during the year, and the closing. Changes in equity shares all the information about the movement in capital, share premium, retained earnings, which is accumulation of profits over time. The profit for the year gets added to retained earnings. Any dividend paid is deducted from retained earnings. If we issue any bonus issue, share premium acts as a savior for issuing bonus issue. Then other components of equity like revaluation surplus, unrecognized actual gain and losses, fair value through OCI debt, equity, equity portion of a compound financial instrument, foreign currency translation reserve. All these are other components of equity presented as part of statement of change in equity. The opening balance, the movements during the year, the closing balance is presented here, and the closing balances are then presented in the balance sheet. They're very much linked. The movements during the year are presented in income statement, whether as part of P&L or OCI. In OCI, it will be the movements leading to items of other components of equity. The changes in equity will have the opening balance carried forward from the last year. The movements during the year will be presented in changes in equity, and the closing balances then will be finally presented in the balance sheet. The financial statements are prepared on accrual basis and keeping in mind the going concern status of the business. If there is any doubt on the going concern status, then the financial statements cannot be prepared on going concern basis. They need to be prepared on breakup model. The fair presentation can override IFRS. If we can prove that the financial statements give a fairer presentation on override, and this can become the basis for changes in the presentation of IFRS in future. So innovation is allowed if it can be substantiated with proof that it does give fairer presentation. Departure of a standard is possible, but it requires a lot of disclosures and courage to do so. That means fair presentation can override IFRS. They need to follow consistently the accounting policies, and how it is being discouraged. For consistency to be implemented, any change in the accounting policy is discouraged by requiring third balance sheet. But if you change an accounting policy, change as if you have been using the same policy since beginning, which is discouraging. Unless it really gives fairer presentation, no one would like to get into this. It is discouraging to change an accounting policy. Changes in accounting estimates are done prospectively. Anything which we could not present into these four statements will be presenting in the notes to accounts. We'll present comparative information with equal prominence. Current year's results compared with the previous year's results, as the results published in isolation will have no meaning unless there is comparative figure presented for the users of financial statements. There's no point giving the results of this year if there is no comparative presented along with it. It makes sense to give comparatives as well. Present them consistently using the same accounting policies which were used last year. And if there is any change in accounting policy, it gets noticed by publishing an additional balance sheet. Third balance sheet is presented. Next standard is IS2 inventories. IS2 is the standard for dealing with valuation of inventories. Valuation of inventories can be done at cost. If the inventories are large and interchangeable, they can use traditional methods like FIFO and weighted average. The modern techniques can be used like standard costing and retail method for departmental stores, standard costing for manufacturing organizations. If we wish to use, we can use them as well for arriving at cost. Now, if we publish these inventories as part of our current assets in the financial statements at current cost, and if we very well know that the inventories were not sold at cost in the next financial year, or we very well know that they will not be sold at the cost next year, it becomes mandatory that we compare the cost with net realizable value and we record inventories at lower of cost or NRV, which will help in recording the losses to the year to which they belong. Because if we do not do this calculation of comparing the cost with NRV, the losses will be transferred to the next year. And suppose the stewards of the business are changing, the losses of the current year will be passed on to the next year, which is not fair. So we make sure that the losses of the current year are presented in the current year when we compare the cost with NRV, lower of cost or NRV, and we recognize the loss immediately. So there could be reversal of inventories in future if the things change or times change, only to the extent of cost. Every year, the closing stock of last year is transferred to the P&L as opening stock of inventories. Whatever purchases we make during the year are recorded directly as an expense in the P&L. At the end of the year, any inventory left with us is again transferred back to the balance sheet, reducing the cost of goods sold, reducing the expense of cost of goods sold, because whatever purchases we made during the year, we were adding it in the form of expense in cost of goods sold. If you are left with any inventories at the end of the year, this cost of goods sold expense is reduced. The closing stock value is taken out of cost of goods sold and is presented in the balance sheet in the form of current assets, which means that we'll be able to realize it within 12 months from the reporting date. As on balance sheet date, we are left with so much of inventory which will be realizing within 12 months from the reporting date. We could not realize it by the end of the year. The journey keeps on moving. Inventories to the balance sheet coming back to the P&L in the form of opening stock, If you are left with any inventories, again it goes back to the balance sheet. Life goes on for inventories. The next standard is IAS 7 statement of cash flows. As I said, it is similar globally. We need to divide the activities of the business for the movement of cash flows in three activities: operating activity, investing activity, and financial activity. Operating activity is the money received or spent in order to run the business. IFRS gives a choice to show interest paid as part of operating activities or as part of financing activities. Interest income as part of operating or as part of investing activities. We can decide that for financial institutions, we can treat it as part of operating, and for other institutions, we can say it is part of investing if it is income, and financing if it is borrowing or expense of interest. Dividends paid is always part of financing activities. Investing activities represent the investment made in the assets of the business, the assets we purchase for generating income in future. Investment in property, plant and equipment, disposal of PP, investment in shares of another entity, dividend received, any income received from our investment properties or investment in assets, investment in shares is investing activity. If we need more funds, we may borrow funds. That borrowings are presented in financing activities. If we sell any PP item, that is investing activities, but if we issue shares for funding, that is financing activity. Any lease liability arrangements which are for longer term is a financial activity arrangement. All our decisions of the business where cash flows have resulted in and out movement is presented in the form of activity in the cash flow statement, which gives a clear picture of what we did with the money, how cash moved in and out of the business. We prepare balance sheet, income statement, and changes in equity on accrual basis, but cash flow gives us a picture of how is cash linked to the profit. Profits may not equal cash. This profitability can be achieved either by selling on credit, buying on credit. Over trading can also result in good amount of profits, but it may not be exactly proportional to the cash the business holds. Next standard is IAS 8 accounting policies, changes in accounting estimates and errors. This standard is especially for the rules, bases, principles, conventions of deciding an accounting policy. If there is an accounting standard issued for a particular issue, we'll use the accounting standard. In the absence of an accounting standard, we'll use the framework for formulating the accounting policy. If the framework doesn't guide us, then we can look at the guidance from other accountancy bodies. If that is also not serving us, then we can use accepted industry practice to formulate our accounting policy. Mostly the accounting standards will guide the policy. Like if I need to use the policy for property, plant and equipment, I'll refer IAS 16 PP. If I need the policy for leases, I'll refer IFRS 16 leases. Only in the absence of the guidance, the hierarchy is given in IAS 8 accounting policies. What to do in that case? Once we have selected an accounting policy, it is not easy to change. Because change in accounting policy will require retrospective application, assuming as if we've been using the new accounting policy since beginning, and also publishing of a third balance sheet. Even if we are willing to correct a prior period error, which we have discovered now, prior period error means not belonging to the current year, not belonging to the previous year, but the error is belonging to a period before the previous year, that is known as prior period error. To correct a prior period error, also we need to publish 3 balance sheets. For change in accounting in policy, for correction of a prior period error, we need to publish 3 balance sheets. Change in accounting estimate, we'll apply the effect prospectively in the current year and future year, will not publish any third balance sheet. We'll make the changes in the current year and future year, will not make any changes in the past. If an entity is using revaluation model for first time, The accounting standard IAS 16 says that applying revaluation model is considered as applying an accounting policy for the first time, which means that if an entity is moving on from cost model to revaluation model, it is not considered as a change in accounting policy. It is considered as applying an accounting policy for the first time, which means they did not need to publish three balance sheets. And once they move to revaluation model, they will never be able to change it to cost model because they'll never be able to prove that revaluation model is not fairer in comparison to cost model. Because to change an accounting policy, we need to prove that it gives fairer presentation. That's why moving on from cost model to revaluation model is considered as applying an accounting policy for the first time and not as a change in accounting policy. In similar manner, changing the method of depreciation used to be considered as a change in accounting policy, but now with the introduction of IFRS, change in method of depreciation is not considered as a change in accounting policy, it is considered as a change in accounting estimate. We'll apply it in the current year and in future years. Next standard is IAS 10 events after the reporting period. Events after the reporting period takes care of all the transactions and events which occur after the reporting date, but before the financial statements are authorized for issue. In this period, there are events and transactions which creates confusion whether they should be included as part of the financial statements which we plan to publish or we should not include them. So we have to decide and classify all the events and transactions which have happened after the reporting date before financial statements are authorized for issue in terms of adjusting events and non-adjusting events. Adjusting events means they give evidence of conditions existing on the reporting date. If they give evidence of conditions existing on the reporting date, we'll make an adjustment. If they do not give any evidence of their existence on the reporting date, we'll treat them as new events, new information, new transactions. We can disclose the financial impact of them, but will not be adjusting them or including them as part of the financial statements published. Like bankruptcy of a customer. The customer was bankrupt on the reporting date, but we got to know about the bankruptcy later. Impairment of a machine, judgment of a court case where we had created provision, now the liability is declared. These are all adjusting events. Non-adjusting events is a business combination. Fire in, go down. The value of an investment falls. All these are non-adjusting events which do not have any evidence relating to the balance sheet date. The non-adjusting events are disclosed. Adjusting events are adjusted and included in the financial statements published. The next standard is IAS 12 income taxes. Income taxes, we need to present current tax and deferred tax with equal prominence in the income statement, and the same will be presented in the balance sheet. A deferred tax is an accounting measure. It has nothing to do with tax authorities. Tax authorities don't even know what is it, or they are not even interested. We'll come across two types of differences. One is permanent difference, one is temporary difference. Permanent differences, we do not have much choice. If they're demanding more tax today, we'll have to pay more tax today because there's no relief even in future. If they're demanding less tax today, they're giving us some relief. We can be thankful. And thankfully, they'll not demand this money even in future. This is a permanent difference. But if they give relaxation in future or demand tax in future, we need to be prepared. These are known as temporary differences. We have to listen to the full statement that they're giving a relaxation, but the second statement is for the time being, and they'll demand this tax in future. When they tax us today, we do not need to feel depressed because the second line is we'll give you relief tomorrow. We'll need to wait or what is the complete decision or impact of their action. So if it is taxable temporary differences means not taxed today but will be taxed in future. If something is not taxed today, it will be taxed in future. We should be prepared for it. We'll create a deferred tax liability that it was not taxed today, will be taxed in future. We need to be prepared to pay a liability in future. So our liability is deferred in the form of tax, deferred tax liability. Deductible temporary differences give rise to deferred tax assets, something we expected to get deducted in the form of expense while computing our tax, but it was not allowed to be deducted. When we asked, they said not allowed deduction today, but will be allowed deduction in future on cash basis. But since you are preparing accounting on accrual basis, you have recorded an expense in the financial statements on accrual basis. The tax authorities only believe in cash. When you will actually make the payment, we'll give you a deduction. Till then, no deduction. Big relief that at least we'll get a refund for this. Not allowed deduction today, will be allowed deduction in future. Means we'll pay more taxes today. We'll pay more taxes today, we'll get a relief tomorrow. We need to create deferred tax assets. According to IAS 12 income taxes, we use the balance sheet approach, wherein we need to know the tax base of an asset and tax base of a liability. Tax base of an asset is carrying amount according to tax authorities, according to what they believe is the carrying amount on the basis of the deductions they allow. Suppose carrying amount of an asset in our books is 100,000 on day one when we purchase it, it's 100,000 for them. But if they give us accelerated depreciation over a period of 2 years, then for them the carrying amount after 1 year is only 50,000. Carrying amount after 2 years will be nil for them. For us, the carrying amount after 1 year will be 80,000 if we believe that the useful life is 5 years. 60,000 after 2 years, 40,000 after 3 years, 20,000 after 4 years, and zero after 5 years. So the pattern of showing expenditure in the income statement is over a period of 5 years, but the same tax statement will expense it off over a period of 2 years. And obviously, the carrying amounts will be different. The carrying amount according to us is 100, 80, 60, 40, 20, 0. Carrying amount according to them is 100,000, 50,000, and 0. So the carrying amount according to tax authorities is known as tax base of an asset. When we compare the carrying amount with the tax base of an asset, the difference between them will result in DTA or DTL. So the principle is, if carrying amount of an asset is higher than tax base of an asset, it will give rise to deferred tax liabilities. If carrying amount of an asset is lower than tax base of an asset, it will give rise to DTA. For liabilities, it is opposite. If carrying amount of a liability is higher than tax base of a liability, it will give rise to DTA. If carrying amount of a liability is lower than tax base of a liability, it will give rise to DTL. In case of liability, it will be opposite of what happened with the asset. And also the definition of tax base of liability will be slightly different. The reason for difference is assets we consume in the business, we generate economic benefits from the use of that asset. Liabilities we settle. Liabilities, there is an outflow of cash out of the business. Assets we consume into the business over a period of time, so we show an expense in the form of depreciation over a period of time. But liabilities immediately disappears from the balance sheet. If you have made a loan repayment, it will not be reappearing anywhere in the income statement or other than cash flow statement. The liability reduces. No impact on income statement. No impact on the tax you pay or relief from the tax authorities. They can simply clap for your good deeds, but they'll not give you any relaxation simply because you have made a loan repayment and you have invited the city for celebration. But tax authorities still will not get moved with this action of repayment of loan. They'll say we don't care. Tax base according to them is same as per the carrying amount, because if there are no future tax consequences of anything, it will not result into any DT or DTL. So there is no future tax consequences of loan repayment. The tax base of liability is slightly different. It says that carrying amount less any amount available for deduction in future. Carrying amount less any amount available for deduction in future. If we have made a repayment of 50,000, does it result in any deduction for us in the form of tax? So carrying amount less any amount available for deduction in future. There is no amount available for deduction in future when we make a loan repayment. No future tax consequences. So carrying amount is same as tax base of a liability. No future tax consequence, no DTA, no DTL. But instead of it, if there was an interest expense which you recorded as part of income statement, you deducted it on accrual basis. Tax authorities did not allow this deduction. They said when you will make the repayment, will allow you deduction. So carrying amount of this tax liability or tax base of this liability in the books is nil. But carrying amount of this liability is say 20,000 in your books, interest payable. When we compared the carrying amount of this liability with the tax base of liability, there is a difference of 20,000. And if the tax rate is 30%, then there is 6,000 of DTA. When carrying amount of a liability is higher than tax base of liability, it will give rise to DTA. In case of liabilities, mostly it is DTA. In case of assets, mostly it is DTL, but don't take it as a rule of thumb. Think through it. For deferred revenue or any money received in advance, the moment the cash is visible in our current accounts, tax authorities simply enjoy taxing it immediately, whether you earn it or not, they don't care. If you receive 200,000 in your bank account for earning in future by providing goods or services, they are happy charging a tax of 60,000 immediately. They don't care whether you'll actually earn it or not, or you'll return it. They'll immediately tax the moment they see cash. Then in future, when you actually earn it, like you have recorded a deferred revenue as part of the income statement, in the balance sheet, you have recorded deferred revenue. In the income statement, you did not record anything in the form of revenue. When you actually earn it, you'll record sales revenue and deferred revenue will be debited. That day, when they see revenue in your income statement, don't worry, they will not tax you again because you have already been taxed. The expectation in case of money received in advance, which is recorded as a liability, the expectation is that carrying amount of liability, deferred revenue is 2 lakh minus any amount that will not be taxed in future. Obviously, full amount of 200,000 will not be taxed in future. Tax base of this liability in the form of deferred revenue is nil. When we compare the carrying amount in the books, deferred revenue, carrying amount, with the tax base of liability is nil, resulting in a temporary difference of 200,000. And if the tax rate is 30%, we'll say 60,000 is DTA, which will be reversed on recognition of revenue. This is how we deal with permanent and temporary differences under IAS 12 income taxes. We'll take a break and then we'll move on to discuss the asset standards.
Yes, Amit. Yeah. Thank you. I'll stop recording now and then
Yes.
I'll again record. Thank you.